Most traders spend their time staring at lower time frames. 1-minute charts, 5-minute charts, constant movement, constant emotion. George Soros and professional traders did the opposite. They focused on higher time frames. Why? Because higher time frames reveal truth, while lower time frames amplify noise. If you struggle with overtrading, emotional decisions, inconsistent results, the time frame you trade may be the real problem. Part 1. What time frames really represent? A time frame is not just a chart setting. It is a reflection of trader behavior, market participation, decision-making speed. Lower time frames reflect retail emotion, short-term reactions, random fluctuations. Higher time frames reflect institutional intent, macro direction, true market structure. Professionals follow structure. Amateurs chase movement. Part 2. Why lower time frames destroy discipline. Lower time frames create false signals, emotional urgency, decision fatigue. Every candle feels important. Every move feels urgent. This environment destroys patience. Most traders fail not because of bad strategy, but because they trade too often. Higher time frames reduce temptation. They force selectivity. Part 3. Institutions operate on higher time frames. Institutions move size. Size requires planning, time, confirmation. They cannot enter and exit in seconds. Their footprints appear on daily charts, weekly charts, monthly charts. Retail traders who ignore higher time frames trade against the real market. Professionals align with it. Part 4. Clarity comes from slower decisions. Higher time frames filter noise, reveal trend, reduce emotional interference. The slower the chart, the clearer the structure. Soros believed clarity comes from distance. Zooming out is a strategic advantage. Part 5. Risk management improves on higher time frames. Higher time frames naturally reduce overtrading, improve risk-reward, allow wider but logical stops. Lower time frames require precision. Higher time frames require patience. Patience is easier to manage than speed. Part 6. Psychological advantages of higher time frames. Higher time frames reduce stress, reduce impulse, increase confidence. You stop reacting. You start planning. Emotion decreases when urgency disappears. This is why professionals last longer. Part 7. Common misunderstandings about higher time frames. Many traders think higher time frame means slow profits. Higher time frame means fewer opportunities. The opposite is true. Higher time frames create higher quality setups, cleaner trends, fewer mistakes. One good trade beats 10 emotional ones. Part 8. Multi-time frame analysis. Professionals analyze high, execute lower, direction from daily or weekly. Entries refined on lower frames. But direction always comes first. Without higher time frame bias, lower time frame signals are meaningless. Part 9. Applying this daily. Start your analysis from monthly, weekly, daily, then move down only if needed. Ask, where is the trend? Where is structure? Where is risk defined? Less trading, better trading. Slow down to win. Markets reward patience. Most traders rush. George Soros did not rush. He waited for alignment. Higher time frames bring perspective, discipline, survival. If you feel overwhelmed by the market, zoom out. The answer is usually there.